ever regretted making a big purchase or been surprised by your credit card bill at the end of the month? Don't worry, we've all been there. Unlike traditional finance theory, humans are not perfect rational decision makers, and we all have certain flaws in the way we make decisions. The area that studies these psychological biases, particularly related to investing, is called behavioral finance. These biases can be categorized into two key types: conscious and unconscious biases. Conscious biases are deliberate and intentional tendencies where we are aware of our preferences and prejudices, like favoring certain investments based on personal beliefs, even if the data suggests otherwise. Unconscious biases, on the other hand, are automatic and often go unnoticed. They are shaped by past experiences, societal norms, or psychological patterns influencing decisions without conscious awareness. Biases can further be classified into cognitive and emotional biases. Cognitive biases occur when the brain takes shortcuts to process information quickly, sometimes leading to incorrect judgments. While emotional biases arise when decisions are influenced by feelings rather than facts. To understand how emotions affect investment decisions, let's explore the roller coaster of emotions that investors experience in the market. At each market movement, investors experience different emotions which contradict the golden rule of investing: buy low and sell high. Speaking of highs and lows, these emotional shifts are heavily influenced by cognitive biases like confirmation bias, which leads to seeking information that only supports existing beliefs; overconfidence bias, that causes investors to overestimate their knowledge or abilities; recency bias, often resulting in giving more weight to recent events or information; anchoring bias, which makes individuals rely too heavily on the first piece of information they receive; or emotional biases like herd mentality bias drives investors to follow the majority without rational reasoning. Loss aversion makes avoiding losses more important than achieving gains. The sunk cost fallacy leads people to continue with an investment simply because they have already incurred losses. Status quo bias causes individuals to favor existing conditions over change, even when change could be beneficial. These biases can significantly impact investment decisions, often without us even realizing it. Let's take a closer look at how emotions impact our actions in the market. This diagram shows how our emotions drive us to buy at market peaks and sell at troughs, the exact opposite of what rational investors should do. For example, confirmation bias can lead an investor to believe that a particular stock will perform well, causing them to read only positive news about it while ignoring warning signs. Overconfidence bias might make a trader believe that they can predict short-term market movements and take excessive risks, often leading to unexpected losses. During market crashes, recency bias might make an investor assume that the downturn will continue indefinitely, ignoring historical market recoveries. Anchoring bias can cause investors to hold on to stocks that were once valued at a higher price, expecting them to return to that level even when conditions have changed. On the other hand, herd mentality can push investors to follow the crowd, buying at market peaks or selling at lows without proper research, making it harder to recognize risks. Meanwhile, loss aversion might make an investor hold on to a declining stock for too long, fearing a loss even when selling could be the better decision. The sunk cost fallacy can lead an investor to continue holding on to a failing stock instead of cutting losses and reallocating funds. Lastly, status quo bias might cause investors to stick with their current portfolio simply because change feels uncomfortable. The first step to overcoming these biases is awareness. Recognizing that these biases exist can help investors pause and question their decisions before taking action. For example, if you notice you're feeling overly confident about an investment, ask yourself, what's my basis for this decision? Am I relying on solid research, or is my judgment clouded by recent wins or emotions? Other ways to manage these biases include slowing down, avoiding impulsive decisions and taking time to assess, questioning your assumptions, challenging your beliefs about the market and investments, using decision tools, leveraging risk calculators or diversification models, seeking diverse perspectives and getting input from different experts to broaden your view, keeping an investment journal, tracking your thought process and staying aware of biases over time. That being said, it's important to acknowledge that these biases will always exist. But the goal isn't to eliminate them entirely. It's about managing them to reduce their impact on financial outcomes. Remember, investing is a journey. The more mindful we are of the psychological factors at play, the better equipped we will be to navigate it successfully.
So much good, so much good. Invest